Welcome to Are You Aware series, a podcast by the International Taxation Committee of Bombay Chartered Accountants Society. We are presenting another special podcast where a young panel of experts will be discussing a topic called the consequences of non-disclosure of foreign assets. I welcome CA Rutvik Sanghvi, CA Mahesh Nayak and CA Kartik Badiani and thank them for their time. They are also the members of International Taxation Committee of BCAS, and all three of them have written a beautiful book called Disclosure of Foreign Assets and Income published by BCAS, which is also now available as the e-copy. You can purchase it by logging into bcsonline.org. We will also share the link in the caption. I now open the floor for this panel to discuss the topic. Mahesh, may I please request you to take this forward?
Thank you, Divya, and hi, hello everyone. Welcome to this session on podcast on the disclosure, non consequences for non-disclosure of foreign assets. So the way we have, structured this, where in a normal podcast, a person asks a question and the other person answers. I think between the three of us, Rutvik, Kartik, and I, we will be asking each other the questions. So all three of us, would be answering some question or the other, and between us, again, some aspect, we would be covering between the three of us. So I think we'll start right away. So Rutvik, the first question to you, I think, to sort of set the context, uh, the Schedule FA in the ITR, why is it important, and what is the kind of information today that the Income Tax Department has? If you can throw some light on that.
Yeah, sure. First of all, thanks to Bombay Chartered Accountants Society for this opportunity. And I think we had a similar topic as a panel discussion topic in 2023, where again a lot of these issues were covered. But between these 2 years, there have been some developments which I think we can discuss out today. Uh, but coming back to your query about why Schedule FA is important, obviously assessment year 12-13, since when Schedule FA had come into play, there was hardly any importance. People were feeling, do we fill it in or not fill it in? There was no requirement as such for whether, as such, mandatory requirement of whether you should fill in or not. Though the law definitely required it, because there were no consequences, people were taking it lightly. Uh, Black Money Act changed the whole thing. And then there's consequences which came in by way of a penalty of rupees 10 lakhs if there was a non-disclosure of foreign assets. Woke certain people up, because obviously practitioners, who are dealing with this area obviously came to know that this is something now which has turned very important. At the same time, there was a lot of information which started getting exchanged with India. Uh, if you, I know viewers may recollect that at that point of time, the government was also very keen that please start disclosing your assets, please, under the Black Money Act scheme. They had also, kind of made it a huge movement that people should disclose their foreign black money. Now, the whole attempt was in that time, if I remember very clearly, hearing Mr. Arun Jaitley, the then finance minister, talking in an interview that by 2017 they are going to get loads and loads of information. Even then, very few taxpayers actually kind of came forward or were diligently filling in this information, and it had its consequences. Over the past few years, we have seen several judgments coming out where people, either due to mistake or due to their own malified intention, have missed out in reporting these kind of foreign assets. This has led to a lot of consequences in the sense that honest taxpayers who have invested even through, let's say, the banking channel, liberalized remittance scheme, still have, when they have missed out on reporting their foreign assets, then they have had to face the consequences of penalty being levied on them. And there have been very strange instances, which I'm sure we will discuss as the conversation goes along. But the kind of information that comes, gets reported, we can put it into mainly the buckets which are there, the four. If you look at Schedule FA, the part A, A1, A2, A3, A4, this is largely the information which does come to India in the form of the CRS form, the Common Reporting Standard, or the FATCA, which has been an agreement signed with the USA. In both these cases, your details with respect to the bank accounts which are held, the custodian or the depository, as in where we hold our investments, or it may be insurance contracts. These are the details which are coming easily and smoothly to India. In fact, to put it clearly to all of the viewers, the fact is that the amount of data which the department is getting is so monumental that they had to open 14 foreign assets and intelligence units across India. And there was a lot of data crunching happening with the help of artificial intelligence, which is the buzzword, but being really applied for this purpose. And a lot of notices had started being issued where there was a mismatch between the data that they receive and what the taxpayer is filing in their own tax return in Schedule FA. So tables A1 to A4 were really very important. Recently, we have started seeing cases where even beyond that, data of immobile properties which are being purchased outside India are also getting reported, and in a span of a few weeks. It is not like something which takes ages for them to get the data. So I believe that it's quite important today that if in case a person, a taxpayer who is a resident of India, has foreign assets or assets located outside India, they must make sure that they are using this schedule foreign assets, Schedule FA, to disclose their assets. So I think by far this would cover. Obviously, there are several schedules to the Schedule FA, and there's a lot of information which is asked for. How much does get exchanged or does not get exchanged, it varies from stature to stature. In fact, sometimes even leaks also actually lead to more information which comes into the hands of the tax department. So one must be quite careful about reporting each and every foreign asset which they own or beneficially hold, or even if they are technically a signatory to a bank account overseas. So these kind of information does get shared, and they do need to report that.
Yeah,
And as I
thanks.
told, yeah, please, sorry, Mahesh.
No, no, sorry. No, no.
So I think the importance, frankly, is now coming because of the consequences of non-disclosure. Because disclosure, frankly, if you go to see it is part of a tax return, which we are anyways disclosing lot many things in the tax return. But because there has been a harsh penalty which is levied onto this non-disclosure is where I think the importance comes from. So if I think it would be
Yeah.
very good if Kartik can help us, kind of pointing out what are those consequences of the non-reporting, and is there any kind of way by which a person who has missed out can probably save himself. So, Kartik, over to you.
Thanks, Rutvik, for that background. The penal consequences of non-reporting of foreign assets are clearly covered under Section 42 and 43 of BMA, correct? Wherein it says that if a assessee who is liable to file a return and has filed a return and not disclosed foreign assets appropriately, or has disclosed inaccurate particulars, or somebody who's required to file a return has not filed a return at all, and thereby indirectly not reporting the foreign assets or incorrectly reporting the foreign assets, is liable to a penalty of flat penalty of 10 lakh rupees. There is an exception, which earlier was a peak balance of 5 lakhs in a bank account. There was no exception for any other assets, non-reporting of any other assets from penalty applicability. That limit has now been increased to 20 lakhs, and it applies to all assets except for immovable property right now. Right. Coming to what really happens in a case where you have inadvertently not reported it, correct? It's not a willful non-reporting, but you've missed reporting it because you were not aware about the provisions or you were not aware about what to really report. Correct. There is Mumbai Tribunal judgment in the case of Leena Gandhi Tiwari, where the AT has really said that the provision of Section 42 and 43 reads that assessing officer may impose the penalty, and the views of expression may really signifies that the penalty is not to be imposed in all cases of lapses, and that there is no cause and effect relationship simpliciter between the lapse and the penalty. So what it really means is that if you have genuine reasons to be explained that yes, no, it was not a willful attempt, it was a mistake, correct? Assessing officer can really waive off the penalty. That's what the tribunal says. In another Mumbai tribunal judgment, in case of ocean diving shipping industries, there the court has really said that if you have actually disclosed that particular asset elsewhere. The facts there were that in the annual report, it was appropriately disclosed. It was a case of a corporate entity who had made an overseas investment. The firm ODIs were filed appropriately, so reporting to RBI was made appropriately. The balance sheet, the annual report, and the related party disclosures did give the details of the subsidiary. Even under investment, it was included, and that investment was also carried into the ITR form in the balance sheet disclosures. Right? So it was really a case of where it was just missed in the foreign asset schedule, but it was everywhere else it was really disclosed. Going by that logic, it specifically really said that Mumbai Tribunal really said that no, there should not be any penalty levied on this particular transaction. So yes, there are harsh penal consequences of 10 lakhs flat penalty, irrespective of the amount, subject to the 20 lakhs exemption we said. So even if there is a 25 lakh asset not reported, you are paying and though acquired through proper appropriate tax sources, correct, reported everywhere else. Technically, theoretically, there is a 10 lakh penalty, even if you've not unreported any income, right? Just because you've not disclosed it in the foreign asset. Over to you.
Yeah, so I think Karthik, the second point is, so obviously this is a case of, when we talks about the ocean drilling case, where you referred to, it was referred to in another schedule on the balance sheet. Now obviously that is in that sense it was a one-off, because I think again what you mentioned in the Black Money Act obviously does not refer, it refers to reporting in the income tax return. It does not refer to specific Schedule FA. But if I, there is one tribunal ruling again, which again says that it needs to be reported in Schedule FA somewhere. So, again, that is there. So again, the law is sort of evolving. But I think so obviously as a matter of precaution, it is always advisable that even if it is disclosed in the other schedules, one has to disclose it in the Schedule FA as well. To avoid unnecessary consequences, because this also went all the way up to the tribunal for the taxpayer to sort of get a relief. But Karthik, I think the second part of the question is, I have missed reporting in the earlier years, and today, the due date for the belated return is 31st of December. So how does one really go about it? Can I file an updated return? What can be done, and what is the practical aspect of it, and what is the risk that is involved?
Right. So what 42 and 43 really say is that if you have disclosed it in the original return or in the revised return, correct, that is, or in a belated return, either of these three, really that is a valid disclosure and penalty is not applicable if you have reported in either of these three. However, unfortunately, updated return, which was a benefit provided under the Income Tax Act, if you have a tax payable later on, after just a couple of years back by way of an amendment, is not been specifically included as an accepted disclosure under section 42 or 43, so as to not attract penalty. Even the last year's amendment, which now allows a modified return in case of a scheme of arrangement, even if you are disclosing in that 170A modified return, that also is not specifically covered under 42 and 43, and therefore technically it's only the original, revised, and the delayed return, which is 139, 1, 4, and 5, which is covered. Not the updated return or the modified return, which are covered for exclusion from the penalty.
Yeah, thanks. To Rutvik, I think so. In case, but practically, if someone has not disclosed, and today I have not got a notice, and maybe I think Rutvik or Karthik both can answer. So I have not got a notice today. While filing my return for this year, I realized that I have a found asset. So this year's return, I'm disclosing it. But what about the earlier year's return? So practically, what would you suggest? Is this something that one should go and file an updated return? Would that have any, would that assist one, in the from the penalty perspective?
Yeah, good question. And in fact, this is a query which comes quite often. A person who is not, kind of disclosed in the earlier years, can he, because there's, what does he do then? Does the taxpayer then disclose or not disclose? And if he starts disclosing, then what about the earlier years? In my view, while Karthik is very right in saying that, frankly, the exception is only for, say, only for 139 subsection 1, subsection 4, and subsection 5, returns filed under those clauses of section 139. One can take a view that yes, at least you should disclose it in an updated return. You got an opportunity to disclose, and why should you leave it out? I understand that while legally you may not get saved from a penalty, I do feel that there have been quite a few cases where they have taken in bona fide cases a position that a penalty should not be levied. And we now today have quite a few cases with regard to those. In fact, we'll put those in the comment section to this particular video, where they have kind of again and again said that if there is a bona fide case, the failure to disclose it should not be considered to be something on which a penalty is levied. It is finally a curable mistake. Now, taking that kind of judgment into context, I would probably feel that where there is a curable mistake, then why should you not cure it? And you should cure it by probably filing an updated return. Yes, it may tomorrow not be considered at all, and the officer may still levy a penalty. But at a tribunal, at the appellate stage or at a appellate stage, I believe that there should be some kind of leniency shown to the fact that the taxpayer has not done it, not done it out of any kind of intention, but it is out of a bona fide mistake. To that extent, I believe that this provision should be utilized. As such, it is available. In fact, the thrust was that use an updated return to come forward and disclose those incomes which you are not, missed out in disclosing. You are being levied a particular penal tax on top of your normal tax. Now, all these are reasons for you to comply with the law. And if you are trying to comply with the law, I feel that that goes a long way in probably, defending your case in a penalty scenario. In fact, I would just like to also point out that quite a few of these situations, we may have to look at it both from a situation where person is defending his or her case when they are not or missed out in reporting their foreign assets, as against somebody who is today to disclose or not, today to take a decision on whether to disclose or not. For the former case where person has to defend their case, I would put it that they should try their utmost best to save themselves from the tax, because in a case of a bona fide mistake, why not, take that case of trying to cure the mistake. When it comes to somebody who is yet to disclose and deciding whether to disclose or not, I would again take a conservative approach because this is a disclosure statement. This has no implications as such on being considered like a balance sheet item or for that matter, something which will trigger further income. It is only that which you are anyways owning outside India that you are trying to disclose. So I think that's the stand we should always keep in mind about when we are advising clients, whether they are trying to defend their own case or whether they are planning to disclose. I think that's where I would come from. Yeah.
Right. So in disclosure in the updated return, you will really be able to defend by saying that it was not a willful non-disclosure. I at least went ahead and disclosed it later before the department came to me. Right.
Perfect.
That
Yes.
becomes it. So Rutvik, from here, I think we mentioned about the 20 lakh exemption which has recently come in. Correct? There is a CBDT circular and an amendment to that effect to the BMA. Correct.
Right.
How do you really read it? And does it mean that if I own assets less than 20 lakhs, I don't really disclose it? How do you read it?
Yeah. In fact, yeah. So anyway, so the amendment what you referred to earlier also when you were also explaining, the amendment is a welcome relief, though may not be the full relief that was probably sought from the taxpayers, but at least it has been a welcome step towards rationalizing these kind of harsh consequences. As you had explained earlier, the 10 lakh rupees penalty was earlier triggering, except in all cases except for a 5 lakh rupees INR balance which you would hold abroad. And therefore, what it happened was that even if I held an ESOP or a particular security which was kind of, very in low in value, it may not be even 10 lakh rupees in value itself, but still the penalty was getting triggered. And the harshness was that the discretion to the officer was only between levying 0 rupees as a penalty or rupees 10 lakhs as a penalty. There was no proportionality as far as the penalty was levied. As in case of income tax, we have, that from 100 to 300% of the tax involved. So at least, you know that on the tax amount. Here, it was something which was a flat penalty. Uh, Therefore, several representations were made, including by Bombay Chartered Accountants Society, and thankfully now the government has, listened to those representations, and they have come back with this amendment saying that instead of this rupees 5 lakhs for only a bank account overseas, they are now told that it will be the threshold will be rupees 20 lakhs for all assets located outside India, except for immobile property. So now let us bear in mind that all practical cases are immobile property ownership will anyways cross the threshold of 20 lakh rupees, but there could be some minor cases where somebody holds a very small share in an immobile property outside India valued less than 20 lakh rupees. Even then they would have to report. Then every other asset, if it is below 20 lakh rupees, then they may not report it. In which case there is they may not be levied a penalty, but whether or not to report it, that does not get absolved. And that's where your second part of the query, that whether they are absolved from reporting itself. No, please let's bear that in mind. Reporting is required for even 1 rupee of an asset located outside India. You do not have any kind of exemption from reporting. Obviously, it goes with very clear standing that you are supposed to report only if you are a resident and ordinarily resident of India. We must bear in mind it does not apply to both resident but not ordinary resident and non-residents. They don't need to disclose at all. There are certain cases we have seen where the definition of residential status is not clearly or properly articulated, because it all is on number of days stay in India. And a large portion of that, if you do not count the days, or if you're on the fringes, and therefore leading to a change of status from a non-resident or a resident but not ordinary resident to resident and ordinary resident, the whole disclosure requirement kicks in. And if that is, caught very late in the day, we have seen at least 2 cases where that has been caught during assessment. And it was not by any kind of intention, but more of an honest mistake in counting the number of days. Therefore, wherever you are on the verge, you may kind of consider that what should be the view taken even for residential status. That being said, once you are a resident or ordinary resident, no leeway at all in disclosing any particular asset located outside India. You have to disclose each and every asset. And the penalty will not trigger if it is below 20 lakh rupees. But there are quite a few consequences apart from penalty that we will discuss during this conversation, which makes it a point that you should ideally disclose as far as possible every asset located outside India. So coming from there, I think one common query another is that, is this penalty for every year of non-disclosure or not? So, if I have disclosed in 1 year, do I again, and missed in another year, can penalty apply for the year in which it is not disclosed? So, Mahesh, can you throw some light on that?
Yes, so technically, yes, if you see the language, yes, technically the penalty applies for each year of non-disclosure. And therefore, if I've not disclosed in a particular year while I've disclosed the other years, technically penalty could apply. But again, seeing the way the litigation also has progressed till now, and that is where I think the courts are looking at, eventually it is there a bona fide mistake, or is it, on a malified intent of you to, not disclose this particular asset? So long as you have taken steps to show that there is a bona fide mistake, and you have disclosed as soon as you have found out, or because the same thing with the updated return today, right? Today you can go updated return only up to 4 years, but what about the years prior to that? I mean, the question always is that you do not disclose at that time. But the point is, today I think if there is a bona fide mistake, we hope that the way the decisions are today, the tribunals and the courts are taking a view that yes, so long as the taxpayer has disclosed it at some point of time, as soon as there's a he's realized the mistake, that should be a good case for non-levy of penalty. But obviously, that being said, it's a question of at the time of defending. So obviously because then does one want to go all the way till litigation for till the tribunal or the high court? That's why always better that make sure that you disclose it every year. Don't say that, okay, I've disclosed it in the previous year and not going to disclose it now. So always advisable, as an assessee, that you need to continue disclosing it
Very true.
every year. But I think so. Rutvik, I think we were talking about the consequences.
Hmm.
So is penalty the only consequence here? Is that the only consequence, or is prosecution also can one also be prosecuted for non-disclosure of any foreign asset or income?
Yeah. So this is where the harshness actually goes, or rather it goes beyond a particular reasonable degree. The fact is that Section 50 of the Black Money Act also brings in prosecution. And if you allow me, then I will read that specific wording, where it says that, punishment for failure to furnish in return of income any information about an asset, including financial interest in any entity located outside India. Now, this is, in my view, some provision where the prosecution also triggers on just non-disclosure. If I would be putting it correct, in my correct understanding of a reasonable law would have been that yes, you have a foreign asset located outside India. The whole intent was to catch hold of black money holders or tax evaders. Yes, that black money on finding out that foreign asset located outside India, obviously the consequence could be one of the consequence could be that yes, the taxpayer has willfully not disclosed or disclosed it because they held a foreign black money undisclosed income outside India, on which case there should have been a trigger for prosecution. So we must bear in mind that while this provision, the title says that yes, there is a prosecution on non-disclosure of foreign assets, it still very clearly says it has to be a willful non-disclosure of foreign assets. Now, what does willful non-disclosure of foreign assets would mean? In my view, it should always be tied in with the fact that there was also an undisclosed income which was represented by that particular asset, and therefore you are trying to bring in both prosecution on non-disclosure of income or non-taxing of that income and non-disclosure of the foreign asset both. And we have had a case where in fact, the High Court has also upheld the prosecution procedures to start in a case where, meaning prosecution sanction was upheld by the High Court because they told that there were sufficient opportunities for disclosure which were given, and even then, where there is an act or an omission which constitutes an offense, then there would be an offense which in this particular case is the offense of not disclosing the asset by itself. Then prosecution sanction was given by the High Court. So I think the gravity of the situation does increase, and we have seen that probably in experience the consequence is such that even if there is an honest taxpayer who has missed out in reporting, there is always a sword hanging that the officer may initiate prosecution provisions. And there have been several cases where they have already initiated it. So in which case, one must be careful because that objective or the fact that this was not willful will lie on the taxpayer. We'll have to prove, even if in case, let us say that the investment was also made from a banking channel in India. They have not linked it with undisclosed income outside India. They were clearly told that, non-disclosure of foreign asset by itself can lead to this sanction of prosecution under the Black Money Act. So one has to be very careful that yes, they need to disclose these assets, and if they do not, they may have this consequence upon themselves about a prosecution, which then they will have to, kind of defend it very strongly with the fact that they have not done it willfully. So I think that's where one must be careful of.
Sure. Rutvik, so what if I have offered my income on the
Hmm.
foreign assets and not, but failed to disclose the foreign assets in the FA schedule? Does it really help from a penalty or a prosecution perspective? I mean, can I really claim that then defend that it's not a willful misstatement because I've offered income? It's only that innocent mistake of not disclosing the foreign asset. How does it really work?
Yeah. I would put it this way that Section 43 of the Black Money Act stands in a different footing than Section 50 of the Black Money Act. Section 43 does not say that there has to be a willful non-disclosure. It only says that there is a non-disclosure. So that by itself is a very automatic provision, the way the tax officers also treat it as. There are very few cases where the officers have taken a discretion of not to levy any penalty on non-disclosure of foreign assets. In most other cases, they have gone ahead and said that please go ahead up to the appellate stage, you may win the case. But at this particular moment, we don't have any discretion is their view, and therefore they say that a flat penalty of 10 lakh rupees will automatically apply in case of a non-disclosure of assets, even where the income is clearly disclosed. Tax paid income doesn't matter. Even if there is no evasion of tax, it does not matter. In some ways, this penalty therefore becomes like a flat fee. You just pay the fee because you have not disclosed the asset. Obviously, you can go ahead and appeal it, and there are several appellate orders now which have upheld that there are bona fide cases you should not be levying the penalty. On the other hand, there are some appellate cases where they were held, even if you sent money from using the liberalized remittance scheme, utilize the banking channel from India, all funds gone from tax-paid funds, even then penalty has been upheld. So both cases are standing on the footing, and we still wait for more development of law. Hopefully, there will be development of law at the High Court and the Supreme Court level soon enough to have a finality on this issue. But as far as prosecution goes, the terminology, as I just briefly explained earlier, that it is on willful non-disclosure. So do we say that the non-disclosure is willful or not is something which you may have to kind of it becomes a very difficult exercise in my view. Non-disclosure itself shows that you have not disclosed. What is willful and not willful against that, so that becomes a problematic issue. But definitely, if you got an advice saying that yes, you are not supposed to disclose, and that advice has turned out to be wrong, I'm very sure that you can take that stand to say that this was not a willful non-disclosure. It was something where I had taken advice and I was probably the interpretation of the law was differently held, or whatever may be the case. The disclosure definitely was not willful. The non-disclosure was not willful. So to that case, I believe the prosecution provision of Section 50 stands differently from Section 43 of the BMA. So Um, Now then we come to finally the fact that we do need to disclose each and every foreign asset located outside India, and that considering all these consequences, I'm very sure the viewers will also very clearly understand we need to get on to track and finally submit all the every taxpayer has to disclose their foreign asset, but there are so many different terms. So Mahesh, can you guide us about how one should interpret these terms? Is there any guidance, any help where person can understand what is a depository account, what is a custodian account, where does one disclose one item or the other item? Then there are certain items like, for example, investments in a foreign security. Where do you exactly disclose it? So if Mahesh, you can help in interpreting those terms.
Sure, thanks, Shakti. So certainly, so see if when we see assessment year 11, 12, 12, 13, when Schedule FA started, in the return, at that time, it was very simple. It was bank account or investment or shares held in another company. So it was table A, B, C, D. It was
Yes.
very simple. And E, I think. So E was a signing authority. So there were only five tables. It was absolutely, very simple. But with FATCA, CRS coming in, they from 16 17, I think they have expanded the table significantly, and I think if we just see the table in the the form itself, without filling itself, it is 2 pages, the schedule FA. The number of
True.
tables that is there, it's extremely confusing, and the terms again used are not something that one uses in common terminology. If one sees, so like you mentioned, a depository or a custodian. So where does one really disclose, or how do you
Yeah.
interpret the terms? So there again, if you see the way the terms have been, the terms that have been used, they're similar to what the reporting happens under the FATCA and CRS. So again, FATCA is for US financial institutions. So for any US person, the financial institutions are required to report to the US government under the this thing in respect of the accounts that have been held in these financial institutions. Similarly, CRS, the common reporting standards, is for the rest of the world. So there is a lot of exchange of information that is happening, automatic exchange of information that is happening under this FATCA and CRS. And again, and if you see the way it has come, right, they are trying to match it with your exchange of information that is coming in, which is why if you see earlier, the schedule FA was for the previous year or for the financial year
True.
assessment year,
True.
and slowly it has now moved to calendar year, because they are getting the information on a calendar year basis, and therefore so one can look at the terminology that is defined in the FATCA or the CRS regulations, as well as you have income tax rules also which define the terms which are used for FATCA. Similarly, you also have the guidance note issued by the CBDT on FATCA and CRS, which sort of gives some explanation as to where does one what is meant by depository. So, for example, depository is your bank account. So those are terms that are there clearly in FATCA, and which is same thing coming in your schedule FA. In fact, even last year in November 2024, as well as in July 2025, the CBDT had this campaign, where they were talking about please disclose your foreign asset, and where they again referred to exchange of information coming in under the CRS FATCA, and therefore they even there is some sort of guidance. One can say, one can consider that. Therefore, effectively, even the CBDT is also taking that position, that try and match it with the
Mhm.
CRS and FATCA reporting, because that is
True.
eventually that is the information that the tax officer will have before him when he looks at your return. So that is, I think, important. So that therefore you can look at the terms that are used under FATCA. In terms of shares, I think again a common this thing, again there is a this thing whether you can disclose it in table A3 because it talks about equity interest, or table B or table D. And I think between the three of us, I think we have been discussing this for quite some time, and I don't think we have a particular answer. But at least my view is, if you see from where it has come, when it started with Schedule FA, at that time you would have disclosed it in table B, and therefore possibly the view is that going forward also I mean, you now you would report shares, whether listed or unlisted shares in table B. That being said, again, it really does not matter so long as you have disclosed it even in another schedule, because I know practically, a lot of times you end up reporting the listed shares at least in table A3. Now that really does not, because at the end of the day you have disclosed it, and again there is no real hard and fast guidance that is really given by the security on this aspect. and therefore, I think that should help at least in reporting. Uh, coming to other aspects of Schedule FA. So, you have this, you have this concept of peak balance that you need to report, especially in table A1, A2, A3, and A4.
Yeah.
Now, how do you really compute that peak balance? Do I need to convert each and every day, each and every balance, individual balance into, INR and then do it? Or, can I compute it in foreign currency? And so what is your view there?
My view is that this form itself needs a change. The reason is because the reporting which is happening from overseas is actually in that foreign currency. And therefore, when it comes to a conversion into INR, we are always getting confused about how and where to report, what foreign exchange rate to be utilized, and what date should be taken for that conversion. So this keeps on hovering. I would put it this way that as you also explained that the information is coming from overseas, it is coming in a particular format which the CRS form or the FATCA form is actually enabling that. In my view, therefore, the peak balance has to always be looked at in the foreign currency concerned. And once you have looked at the peak balance, let us say in the span of the calendar year, let us say that on the 31st of May, sorry, on 30th of May, you have the balance, which is the peak balance. Then you particularly take the foreign exchange rate as of that date, convert it into INR, and then report it. Now, this is not the only place where these kind of questions get asked. What we generally do is that whenever we are reporting the schedule FA, we also replicate that schedule FA into a statement where every reason and every notes to the schedule FA are provided, including what date we have taken as a peak balance and why, including what conversion rate has been taken, what is the source of that rate of conversion. This kind of document will go a great way in helping out in future whenever there is an inquiry, and then you can at least justify that this is what we had done, because maybe 2 or 3 years down the line when the inquiry comes, you should be able to explain them that yes, this is what we have done. In my view, that by itself should not be an issue. We have had cases where they were asked to reconcile the INR amount, and then we had to tell them, that finally a difference in the foreign exchange rate. Where are we taking it from? There are not in every case will we get an SBI TT buying rate. There will be cases where you may have to go to for example, the RBI's website, even when you go to Oanda's website or some other private website online which provides those rates. But that being said, to answer your question, Mahesh, I would put it this way that a peak balance always has to be probably looked at from a foreign currency angle. Once that is the peak balance taken, then we convert it into INR and keep a proper note for support of why we have done that and what rate we have taken it at. So then, I think this part about peak balance is getting covered. Then we have also cases where there are multiple investments, and then every investment that we have, let's say that I have invested probably on 10 scripts of, Apple Inc. over the period of the year. Then do I report it as, 10 shares of Apple Inc? Obviously, I hope one day I can be rich enough to buy 10 shares of Apple Inc. immediately. But that being said, that can I do I report it in one line item, or do I report it 10 different ways? If Mahesh, you can share, and if Kartik later on you have any views, do share that also. Yeah.
No, certainly. At least, I believe, yes, because if you see the way the table is, it talks about investment in an entity. And therefore, one may take a view that, you do it on a consolidated basis, because your date of first investment you take as you take the date of the first investment in that particular script during the year as, the opening or the first date of purchase, and you take the this thing. But that being said, again, the point is, it is about convenience today. The way the information is going to come to the tax officer would be on individual transactions that have been undertaken on the exchange or with the financial institution. So therefore, for them to, it should, if you have, let me put it this way, if you have put it on a consolidated basis, it's not, you will not be charged, you will not be charged a penalty. It will not be inaccurate particulars possibly, but you will still have to go and explain it to the, the officer, and therefore it is easier for one when one has a situation where the officer is getting the information on the individual transactions. You report it also on individual transactions. Kartik, do you have any other view on this?
No, so I agree with you, Mahesh, and I think even in exchange of information, they probably will get like each line items, and therefore, if you really want to match with it with no specific queries to be answered, then probably each line item is advisable. But even if you report a single consolidated item, that should be sufficient reporting. Only thing you'll have to go and explain them the breakup again.
Then, in fact, the next query which comes up then, on the very famous issue of stock options, there are so many, taxpayers who have got stock options as part of their employment benefits plans. And to an extent, when does one disclose it and how to disclose it? If Karthik, you can guide everyone.
Sure. And with increasing number of startups doing internalizations, externalizations, this has become all the more relevant and important now that Indian employees holding ESOPs of foreign entities has become a very normal thing these days. Correct. So there are typically multiple stages of an ESOP scheme, correct, where an employee is first granted the option. Then there is typically a vesting period during which the option gets vested to them, and then after that vesting period he will have a right to exercise the option and convert it into shares. So typically on the grant date, there is really no right, no capital asset, no asset that he is holding. It's just an hope which he gets, that if I perform the conditions, that there could be time-based condition, there could be performance-based condition, there could be some multiple conditions attached to the vesting, correct? And if those all conditions are performed and completed within the prescribed time limit, then really speaking, you will get a right, correct, to acquire the share. And in that particular case, as on the date of grant, because there is only a hope, according to me, there is no reporting requirement. Once the option is vested, correct, again now we need to be very mindful while reading the vesting conditions in the scheme, correct, because nowadays I've seen a lot of schemes where only time vesting is not a condition. Typically there are vesting condition 2, 3, 4 where they are pegged with a liquidity event being achieved by the company, correct. So if you have, although you have completed the time vesting condition, if the liquidity event is not occurred, then again you don't, it's not completely vested option, you just completed the time vesting. But assuming you've
True.
completed, there is only a time vesting or a performance vesting condition, you've completed it, correct? Which means you have an unconditional right to go ahead and exercise it during the exercise period. That is when you are actually holding an asset, a right to acquire
True.
a share, correct? That's a capital asset clearly defined under the Income Tax Act, and therefore on that date you should ideally start reporting your asset in the foreign asset schedule if it is a share in the foreign company that is going to be received by you, correct. Again, there could be again a complication of a termination clause in the scheme, which probably might say that although some options have been vested, part of it might lapse if you leave the employment after that, correct. And even in those cases, it is actually advisable till the time of termination. If there are vested options, please disclose all of them, correct. And once the termination event occurs and there is a lapse, after that you can maybe start reporting the reduced number of options which you are actually allowed to exercise, correct. Once the option is exercised and you receive a share, correct, then again you have to start reporting it. Probably in the year of exercise you might have to report the option as well as the share, because you are holding both for a specific, because the reporting says at any point in time during the year, correct. But from that date onwards you have to start reporting the share, because then you are holding the share in the foreign company, correct. And let's try and be conservative, because there could be multiple interpretation of the scheme. Please start reporting once there is a vesting, and then through to the exercise.
I agree, and in fact, I would just like to point out to the viewers that in fact the department has also come forward and involved a lot of tax advisors to intimate to their own clients that please do report all your stock options, because they have received huge number of such data from abroad stating that a lot of taxpayers had not reported their stock options. Now, even the department is aware that in most, I think almost all such cases, the taxes have already been paid or are to be paid, or there is no such perquisite which comes into play, thereby saying that there may not be any instance of an undisclosed income, and therefore the whole issue was that the department therefore came forward and said that why don't you advise your clients to please report it, revise the return, and then report all the stock options. I would also put it that, as what Karthik also mentioned, doing to be slightly being more conservative, I would put it this way, that if you are not sure, report it. Forget about when and what, just report it. If you are in a particular situation where you are missed out in reporting, and now you're trying to take a stand, then yes, from the vesting and what conditions which Karthik did explain. Otherwise, if you are not very clear, just report it, because it's not going to change anything. Frankly, it's just reporting and then it stops there. So I think that at least saves you from unnecessary litigation going forward, or not just litigation, but even just normal inquiry.
Yeah,
So
Yes.
absolutely.
Yeah.
Absolutely. I think completely agree. I think with Rutvik and Karthik on this that I think when in doubt, do disclose. I think it's easier
yes.
that way. So I think before we go to the before we end, I think just so there are obviously other places in the ITR. One is supposed to disclose. You have the obviously other than Schedule FA. So for example, if you have a bank account, then you're supposed to disclose it also along with Schedule FA in the respective schedule in the ITR. Or you have,
Yes.
if you're a director in a company, you may have a signing authority of your foreign company. You're supposed to disclose in Schedule FA as well as in the this thing as well, director details as well. Similarly, if you have unlisted shares, that also needs to be disclosed. Or if your income is exceeding 50 lakh in a year, then schedule asset liability AL applies. So there also again you're required to disclose. So I think important to keep that in mind that just because you have disclosed in Schedule FA does not mean that you have not does not need to disclose in the other schedules, because to make sure that it is not inaccurate particulars of in your return, it is important that you disclose in the other schedules as well. But I think before we just end, I think Karthik, Rutvik, Karthik, I think to you first, any practical experience, if you can share in assessment, on in respect of under the Black Money Act on foreign assets disclosure, if you can share, and then maybe Rutvik can share something. Yeah, please.
Sure. Before I go to that, just Mahesh, on the point that you made, one small additional point is that different disclosures are pegged with different types of residential status. That is also to be kept in mind. Like some things will be applicable for a resident, something will be applicable for a NOR, some disclosures might be applicable even for non-residents. So that needs to be really taken care of while you file the tax returns. Correct. On the assessment experience, the experience on at least 42 and 43, I can share is that if there is no disclosure, even in 1 year, the officers typically have been taking a stand that 10 lakh penalty is levied. If it is multiple years, they do 10 lakhs into the number of years, correct? Even at the first appellate level, we have seen a situation where the commissioner is accepting, that it's not a willful error, it's a mistake, correct? Because you have disclosed it elsewhere, or because you've reported the income, and because it's out of the will or out of the tax paid sources, disclosed sources, correct? However, at least at the first appellate level, you don't see something going in your favor. But at least tribunal at almost all levels in multiple judgments have gone ahead and seen whether it is a willful error, willful mistake, or it's a error, or a innocent mistake which the assessee has made, and accordingly have given a benefit in multiple, like we discussed, in multiple tribunal judgments, correct? And therefore, yes, if you are saying assessment and first appellate level, I think be prepared if there is no disclosure, even if it is a mistake. Be prepared. It'll be a 10 lakh into the number of years penalty, which then probably you might get a benefit at the tribunal level. Rutvik, please, in case you have any different experience or any points to add.
Uh, no, yeah, so agreed. I fully agree with what you told. I think the only point I would like to, state here is that again and again that, let's be, at the stage of disclosure, let us be all in disclose as far as possible. The reason is that we have had cases where there have been honest mistakes even by the foreign reporting entity. And in that kind of cases, also the department comes back saying that, okay, fine, now explain us what has happened. And in those cases, ideal situation should be that you explain that there is no, there is nothing, there's an error by the foreign reporting entity. We have anyways disclosed everything. The matter should end there. But it does not. In typical all such cases where you even have just one asset being found out by the department which they feel is a mismatch, you may even clarify that there is no mismatch. Still, they will go into each and every foreign asset reported in the foreign asset schedule. They will then ask that, okay, what is the source of that foreign asset, and whether that source of that foreign asset is an income which was taxed in either India if it was the years when the person was resident, or especially for that particular period. Now this means that you may even have to go back multiple decades. We have had cases where we had to ask the client for some 30-year or 40-year-old document, and the client obviously, a lot of cases will be there where they don't have those documents, especially for people who have moved abroad, stayed abroad for a long period and then came back to India. In all these cases, uh, the officers themselves are very clear that if you don't have supporting documents, then what can we do? Now, bear in mind the inquiry had started with something which was obviously very, very innocent and could have been explained away, and in one submission matter would have been over. But then this goes into multiple months of, discussions and communications with the officers concerned. So I think one must bear in mind that yes, by far, also keep in mind that even if you are a non-resident, or if you are a recent non-resident who is, meaning a person who has returned back to India, do not, think of destroying all those documents or thinking that they are not worth it. They are worth it because without documentation or third-party confirmations, these officers may not take it on face value, or by the taxpayer themselves telling that yes, this was obviously from incomes earned abroad. So I think that is something which becomes a painful exercise, and therefore, coming back to that, even if there's a 20 lakh threshold, should we disclose or not? Obviously, you need to disclose because penalty is far away and the litigation for that is, far away. First and foremost, the whole investigation exercise is a painful exercise, which why should an innocent taxpayer go through? So I think my motto would be disclose as much as far as possible everything that you can, because yes, you may not go overboard, but at the same time, if something is in a gray area, better disclose and complete the chapter there.
And even if you don't have complete information, please disclose as much as you have with some assumptions, correct?
Yeah.
Because defending no mens rea with inaccurate particulars will be much more easier as compared to defending no reporting, correct?
Very good. Very
So
good
I
point.
think
Yes, yes.
that disclose whatever information you have.
Yes.
Yeah, and yeah,
With a
thanks. I
view
think
with the
especially,
punch.
practically, I think you've seen, in situations like Rutvik mentioned, you're coming back to India, so you had assets which, you had acquired when you were a non-resident. So, if you have acquired something through the LRS, etc., you would have that kind of information. But, when you were a non-resident, you had acquired something, you thought you don't need it. When you come back to India to explain that after you become a resident, it's a challenge. Or, similarly, when you have inherited certain assets, again, you may not have that kind of information. I think so these are typical situations where we have seen, that notices have come and the taxpayers are in sort of a fix. So I think important that whatever possible to that extent information available, at least do disclose that. I think thanks. I think we have had a fantastic time. I think, and we hope that the viewers also, there is something to take away for the viewers as well. So once again, I think thank you to the Bombay Chartered Accountant Society for this
Yes.
opportunity for us to, just again discuss these things. I think every time we discuss, there's something new that comes up. So I'm sure, so
Yeah.
thank you all once again. Thank you.
Thank you. Thanks to BCS. Thank you, everyone.